Hello and welcome. India's biggest IPO of 2025 is here. Tata Capital, all set to raise over 15,500 crores, marking the first Tata Group IPO since 2023. The IPO comes with a price band of 310 to 326 rupees per share. Today we have an exclusive conversation lined up for you with Rajiv Sabharwal, MD and CEO of Tata Capital, to discuss the IPO as well as the company's future outlook and expansion plans. Welcome to the show, Rajiv. Great to have you with us.
Thank you so much. Pleasure to be here.
So let's take a look first at the pricing. By far, it's below the last unlisted market price of 735 rupees. Could you explain the valuation methodology to us and the assumptions that justify the discount?
If you look at the way we've gone about, is the normal process where we meet investors, both outside India as well as in India. We take feedback from our our bankers who've been a part of this journey, and based on their feedback, the board meets and then decides. If you look at the current pricing, that is slightly lower than the last rights which we did, and the whole purpose the board felt was that we should get a much larger set of investors in our IPO, and we should target large retail investors. IPO is the time when you can broaden your base of investors, and that's what we have done, and that's the reason we gave a 5% discount at the upper band compared to our last rights price.
Okay. The issue comprises a fresh issue, Rajiv, of 21 crores. That's 21 crore shares. That's 6,856 crore rupees, and an OFS of 26.58 crore shares. That's 8,665.87 crore rupees. How will the proceeds from this actually be used? What is the plan going forward? How will it be deployed?
So our core business is lending, and that's where we intend using these monies. These monies will help us to shore up our Tier 1 capital. Along with the profits which we earn over the years, the Tier 1 capital will be leveraged and help us support our lending in the future. So primarily, this money will go to support our lending. Part would also help us in improving our digital capabilities further.
All right. At listing, Tata Capital is expected to command a market cap of 1.38 lakh crores, positioning it as India's fifth largest NBFC. How do you view this relative to peers like Bajaj Finance, Geo Financial and IRFC?
Now, we primarily look at the big opportunity which India presents. We are very bullish on the growth rate which can happen in India, and the way India is progressing and making things shape up well. We at Tata Group do enjoy a lot of, I would say, trust which the investors as well as borrowers and lenders place on us, and we want to continue with that. Our whole focus is to create a book which is, I would say, well diversified, can handle all situations in terms of good markets and not so good markets, and continue to deliver consistently. That would be our strategy. And having a well diversified book with 25 plus products would really help us.
All right. For investors who bought unlisted shares at significantly higher valuations, how will you manage expectations and also sustain long-term trust?
Actually, we do not track the unlisted market. We've always been consistent with our approach whenever we have raised new monies. All our past few offerings have been rights issue, and if you look at the way we have priced them, it's a function purely of how well we are doing, what's the situation in the market with our peers, and that is how things have shaped up, and that is how we have looked at the IPO pricing also. Here we have gone in more also with the feedback which we have received from investors, both in the domestic and the international market.
Okay. How is the current lending book structured across consumer, SME, vehicle finance and commercial segments?
If you look at our book, it is about 63% retail, and within retail, half of it be housing and half of it would be consumer.
Okay.
About 26% is SME, and the balance is corporate. So about 88 to 89% of our book is retail and SME. Those are the two most largest segments in terms of growth in the Indian economy. We are largely secured. Our retail unsecured is just about 11% of our total book. The book is pretty granular. 99% plus of our loans are less than rupee 1 crore loans. I think the whole objective is to be present across all segments, and that really helps us in managing risk better and also managing growth better. If we feel an opportunity is more in a particular segment, we have the ability to drive up that segment. If we feel any of the segments are not doing well, we can pull back, and still we have many engines for growth for us.
Okay, and which of these segments will you prioritize? I mean, as you said, you'll track where you feel the opportunity is building, but do you already perhaps have a sense of what perhaps you'll be looking at focusing on more post IPO with some of the new capital?
So our strategy is not to have one hero product. We want to have multiple hero products, and that is what we are trying to do, and that's what we have done. In terms of the largest book, housing is the largest book because this
Okay.
is the asset we are most comfortable with. Close to about one third of our book will come from our housing finance company. The other assets, which will be large for us, will be SME and consumer. We do believe that each of these segments have huge potential to grow in India, and we want to be there, expanding our reach, building our digital capabilities further to take advantage of this India growth story.
What is your current gross NPA ratio and provision coverage ratio, and the kind of trajectory you're looking at targeting over the next 2-3 years?
Our provisioning coverage ratio, if you look at it, we've kept it amongst the best in the industry. It currently is close to about 56% odd. When we look at our credit costs, if you look at our past, we've always, before the merger, been below 1% on our credit costs. It's the mix of assets which we have chosen, which have a bias towards secured, which ensure that our credit costs remain low. Our net NPAs are also close to about 1%.
Okay. And how do you mitigate potential asset quality stress, especially in cyclical or retail heavy segments?
That is purely a function of the mix of assets which we have created. But more importantly, it's I would say the culture which we have driven across the organization. We do believe that we are in the business of risk management, and that should take priority over growth. The other thing is, if you look at our team, each one of our team members comes with huge experience in large banks or large NBFCs, has seen multiple cycles across the industry. And even more important is the fact that our team is extremely stable and we have very low attrition, which just keeps us core to our strategy of keeping risk at the top of the agenda.
All right. Rajiv, what's your current average cost of funds, and how sensitive is your net interest margin to fluctuations in funding costs?
So we try to balance, our amount of money which we raise through fixed or floating and the amount of lending which we do through fixed or floating. So if we factor in, the whole, I would say, the total assets and total liabilities, and factor in the money which we are raising from the market, which will support tier one, there will be very little gap between, the nature of book in terms of assets or liabilities. So we will be fairly balanced. So any change in interest rate should not have any significant impact on our margins. As far as cost of money is concerned, currently, we are raising money which is at a price of anywhere between 7 to 7.2%. And as the past book keeps repricing, most of the cost will move at these rates.
What levers do you feel will drive margin expansion, Rajiv? And, greater fee income, better cost efficiencies, cross-selling, digital penetration. What perhaps are you looking at in order to drive things on that front?
So if, digital has clearly been a differentiator for us. We've used it across the whole value chain and across all the products within the organization. In fact, digital is helping us discover new segments and make them viable for us. We've of late also been investing a lot on the Gen AI space. And the projects which we have rolled out on the Gen AI space are becoming accretive to us in driving operating efficiency. As far as you spoke about the what will drive margins, I think there we are looking at a few things. One is our proportion of business which will come from high yield products. For example, in the housing business, we are growing affordable housing at a much faster pace than the overall housing. We are already among the top 2 or 3 players in the affordable housing space. Some of the products like leasing are helping us further improve our margins. We've launched new products like secured business loans. And these are some of the products which will help us to increase our margins going forward. Margins are also a function of cost of funds. As you know, we also had an international rating which has got upgraded as the Indian sovereign rating has gone up. And the domestic market, we are AAA. So we do expect cost of funds to also help us improve margins. Also on the fee side, we are into some businesses which have a huge potential to scale up. For example, we are into wealth management. We believe as it scales up more, it will drive more fee income. We are also into the AIF space. We have a couple of private equity funds which are doing extremely well. And as they scale up, they will be also accretive to us on the margin side without consuming, too much of capital.
Okay, this really helps to give us a nice comprehensive overview, Rajiv. I know you talked about how you don't have a hero product, how you're looking, of course, cross-segment, talked about housing, talked about the opportunity in India. Is there any kind of indication, when you spoke about deploying funds and on the lending side, in terms of the incremental capacity the infusion will create, are we looking at kind of a number there that you can indicate to us? And also going forward, you've of course spoken about the margin picture, but anything else you'd like us to know in terms of culture or in terms of strengths at Tata Capital, whether it be AI, like you just mentioned, whether it be technology, digital infrastructure, anything else you'd like us to know about the company?
I think when I mentioned we don't have one hero product, we believe that we have multiple hero products. That is the strategy so it's going to be a multi-starter rather than a single starter. That's the strategy which we will adopt. The other thing a couple of things I want to point out here is that we've always worked at Tata Capital of keeping credit costs amongst the best in the industry. They've always remained below 1%. They did move up a little bit because of the merger which we did with Tata Motor Finance, but we are pretty sure that over a period of time we can get it to sub 1%. The other thing which is playing out very well for us, we did some amount of upfront investments in our branch infrastructure as well as on technology. And along with AI, that is giving us significant benefits in terms of bringing down cost to income or cost to average assets. Just to give you a sense, in our housing finance company, we have brought down our cost to income from about 40% to 31% in just about 2 years. So this whole benefit of India stack, along with our investments in technology and AI, are now going to bring about a step change in the cost of doing business. And we do believe that the more we benefit, we will be able to pass on benefits to our customers, and that will be accretive and will create a cycle which will then support even more growth. So it becomes a cycle which is self-sustaining and keeps improving over a period of time.
All right, fantastic. Rajiv, great speaking with you. It's a mega IPO and one from the Tata Group. We are waiting and watching to see how this will play out and impact the market and create opportunities for investors. We look forward to it, and we look forward to speaking to you again post-listing as well. Thanks so much for joining us.
Thank you so much for having me here.